Business Cycle Explained Once and Forever. Part 3. The 2008 Global Financial Crisis, a real-life example. So far, we've understood how a business cycle works. Now let's see how it happened in the real world. In the early 2000s, house prices in the United States were rising rapidly. Many people believed those prices would continue rising forever. Banks also became optimistic. They approved housing loans to many borrowers, including some whose ability to repay was weak. As long as house prices kept increasing, everything appeared normal. But eventually, house prices stopped rising and began to fall. Now many homeowners have faced a difficult situation. Some discovered that their outstanding home loan was larger than the value of their house. At the same time, some families lost income or found it difficult to make their monthly loan payments. As more borrowers failed to repay their loans, banks suffered heavy losses. To protect themselves, banks became much more cautious. They reduced lending not only to home buyers but also to businesses. Now think about what happened next. Many businesses wanted loans to build factories, buy machinery or expand production. But borrowing became much more difficult. Without enough finance, many companies postponed investment. Some reduced production. Others froze hiring or laid off workers. As workers lost income, they reduced spending on cars, furniture, electronics, and many other goods. Businesses now received fewer orders. They reduced production even further. The slowdown spread from one industry to another. This is exactly how a contraction develops. But the story didn't end there. The United States is one of the world's largest economies. Many countries export goods and services to American consumers. When Americans reduced spending, companies around the world received fewer export orders. Factories in those countries also reduced production. Some workers lost jobs. At the same time, many international banks and investors had invested in American financial markets. When those investments lost value, financial institutions in many countries also suffered losses. To reduce risk, they also became more cautious about lending. Investment slowed across many economies. Gradually, the slowdown spread around the world. That is why the 2008 global financial crisis became a global recession, not just a problem for one country. To support recovery, governments increased public spending, while central banks reduced interest rates to encourage borrowing, investment, and spending. Gradually, confidence returned. Businesses started investing again. Production increased. Employment improved. The economy slowly moved from contraction back to expansion. Now here's the biggest lesson from this entire example. The crisis did not spread because every country had the same housing problem. It spread because modern economies are deeply connected through trade, investment, and the global financial system. When one major economy slows down, businesses in other countries receive fewer orders. Banks become more cautious. Investment declines. Jobs are affected. The slowdown spreads across borders. That's why economists don't study the business cycle only within one country. They also study how economies influence one another. Remember, the 2008 global financial crisis teaches us one powerful lesson. A business cycle is not created by a single event. It begins with one economic shock, but it spreads through a chain reaction affecting households, businesses, banks, investors, and governments. Understanding that chain is far more important than memorizing dates or historical events. Now that you've seen the business cycle unfold in the real world, one question remains. Why do governments and central banks care so much about the business cycle? In the final part, we'll answer that question.